That Great Business Show, Ireland's best business podcast.
ThatGreatBusinessShow.com is brought to you by De Facto Shaving Oil, the best anyone can get. Made in Ireland, sold worldwide.
Welcome to episode 120 of That Great Business Show, Ireland's best business podcast, posting on the 30th of December 2022. I am Conal O'Moran. As always at this time of year, we're doing things a little differently with a couple of special podcasts with some exceptional business people. On this episode, we want to tell you how to make money. And who doesn't like that? And we know that making money is not that easy, so we have someone special for you as we look forward to a prosperous 2023. A recognized expert in his field and a man who I have interviewed about investments many times before. And that's because I believe he knows his stuff. So sit back or throw on the headphones for the next 45 minutes or so as we bring you the easy money edition of That Great Business Show.
De Facto Shaving Oil, the ideal gift. One bottle lasts a year and they'll think of you every day.
Aidan Donnelly, Head of Equities at Davy, welcome back to That Great Business Show.
I am thrilled, and I almost didn't recognise who you were interviewing after that long monologue.
Oh, it was a bit of a monologue, but it was kind of like a drum roll. Really.
It was.
But you are coming welcome back because you have been on before, haven't you?
I have, and in past incarnations, multiple times.
FM, exactly. So, you want to start, because you've just told me how to do this interview. You want to start by looking back. So long as you look back and explain to the world what was wrong, what is wrong, what will be wrong with crypto, and what an absolute load of horse crypto is, was, and will be. That'll be a good place to start.
It will be a good place to start, and it probably refers back to the last time I was on this show and we had a similar discussion. At that stage, the price of Bitcoin was, 60, 70,000, something along those lines, and we all know now that it's back. But
it still has got a value, which makes no sense to me.
No, I would agree with you, but what has happened to it is a little bit symptomatic as what's happened to parts of the equity market this year and parts of the wider investment market this year. And that is, if you look back through, the even go back as far as the global financial crisis, but more lately when we saw COVID pandemic hit in March, what happened was central banks went out, started pumping loads of money into the economy through quantitative easing, and then also by slashing interest rates right the way down to zero, and bond yields, which is government debt, the price of government debt went into negative territory in Europe, and there was so much money sloshing around. And basically, you had a situation where, if you were a speculative asset like Bitcoin, or if you were a company that was more hope than strategy, in that you weren't making any money, you were burning through money, but you had the next best idea. The market, because the price of money was either zero or negative, no matter what financial metric or discounted cash flow model that you wanted to use, or return on invested capital type thing, you could make basically any idea stack up. And that's really what happened. We got an awful lot of froth into many areas of the market, not least of all, and unfortunately for an awful lot of retail investors, they started getting into things that they didn't know, they didn't understand, but Johnny down the road or Jane down the road were doing it and they'd made loads of money, and sure, that must be easy, and therefore let's go. And as we all know, when the music stops, you better make sure you have a seat underneath you, or else you're going to end up on the floor. And that's kind of what's happened. And I think the thing to bear in mind, and we would have said it at the time, and I get asked about cryptocurrencies and Bitcoins and all that type every time I do a client event or things like that. And the simple rule I've always had is going back to a man that you'll know very, very well due to his longevity in the investment world. It was Peter Lynch, who headed up the Magellan Fund for Fidelity. And Peter always had this saying, he says, you need to know what you own and know why you own it. And you could call me stupid, whatever you like, but I never really understood what Bitcoin was. So no matter what reason I could magic up in my head as a reason to own it, other than the greater fool theory that I was going to find a greater fool to buy it off me, I just said, you know what? Don't really think so. I definitely don't think it's for me. Now, I do think the idea of blockchain technology,
that's a different thing.
Completely different thing.
And we won't go down there because that's not going to make anybody any money unless you have a blockchain company, a company that...
Or you use the technology. I think actually the use of the technology is massive, and the applications of it are huge. And I think that far more than the price of a dancing ape GIF is going to make people money.
This is the easy money edition. So please start telling me how to make some easy money in 2023.
Well, it was very difficult to make any money in 2022, and it was a very unusual year in 2022.
But why was it so difficult? Since companies, many of the economies were past tense going okay, and proper companies were doing okay. So why was it not easy to make money?
Well, what you had really was, and what made this year an unusual year, typically, if you look back over the last, 100 years, if the equity market is going through a bit of a wobble, the bond market is doing well. And if the bond market is going through a bit of a wobble, the equity market is going well. And that nice yin and yang that kind of developed and has always been the case went completely out of whack this year in that there was no place to hide. Bond markets were down. Why? Well, inflation was going up, which meant interest rates were going up, which meant bond prices were falling. At the same time, within the equity market, you had, with bond yields going higher, the valuation that the market was, investors were willing to pay for the market was coming down. And that's the really interesting. If you look at the performance of all the major markets this year, they've all seen corporate profitability actually grow in 2022. And you might say to yourself, well, then why didn't the market go up? Because it's not just about one part of it, i.e. the earnings growth, it's also about the valuation multiple. And we've seen a substantial decrease in the valuation multiple, or the old PE ratio.
Now, you better start out explaining that this is meant to be the easy money edition. So when you go off with your CFA type words like PE, you lose people.
Price to earnings. It's a measure. It's a measure. It's a way of valuing a company. And
once upon a time, that PE, if it was around 10 or 12, that was a good price to buy a company.
Yeah.
Then it went to 20. Then it went to 30.
Yeah.
And then it went to whatever you chose. It never made any sense.
Mm-hmm. Now, what happens ultimately there is, when you're looking at individual companies, you can get a whole spectrum across from zero to from 2 to infinity because of the nature of it. But basically, what you're doing is you are saying how many years of profit that this company is generating today am I going to pay? So if it is a price earnings ratio of 10, you're basically saying the price today is worth the next 10 years of profits, okay, on a per share basis. Now, what we've seen is, and there's lots of things that impact, the valuation when we're looking at equity markets, the valuation multiple or the PE multiple is kind of like a sentiment indicator. When it's very low, people are very worried. When it gets higher, people get more confident and less risk averse. And during the period of all of that really cheap money, you're right, we did see the valuations creep up. So in this year, when we came in and we started to see inflation higher and stickier, and central banks needing to do whatever was necessary to get inflation down. Bond yields went up, and that all made for probably, you know, a little bit more kind of risk off, as in people got a little bit cagey about risk, and therefore the amount or the multiple of earnings that they were willing to pay for the market or for an individual stock came down. Now, what you had, that's kind of at the very surface of it, but underneath the surface, yeah, in some cases you had a very rational sell-off in the market, where, going back to those things when we were talking about Bitcoin, the hope stocks, right? It made perfect sense for, once interest rates were going up, that those stocks were getting particularly hammered, right? Because, you know, you're really looking way out into the future before you actually start making any money. So, you know, you better be damn sure that what you've got.
Well, actually, just on Bitcoin, because it still bothers my head, there was never, ever going to be a return on it because it doesn't do anything. It's just a token.
Yeah, it's a bit like gold.
Yeah.
But at least gold has a fundamental value, if nothing else, to buy jewellery, you know?
So, we know that's the past. I'm still waiting for you to tell me how I'm going to make a fortune in 2023.
I think it's going to be difficult to make a fortune in 2023.
A small fortune.
Well, you know what they say. How do you make a small fortune in the stock market? Start with a large one, you know? But I think what's really important is, because we're still in an interest rate increasing cycle, volatility, and that's been the other big thing that's been at play and very apparent in 2022, has been the level of volatility. And there's a reason for it, and it's worth discussing, but we'll discuss that in a minute. But if the interest rates are going to continue to go up into next year, that volatility is going to remain.
And are interest rates going to continue to go up?
Yeah, I think they will.
By much?
I think probably you will see... Well, look, I would say to you, it's funny, when we came into this year, just to give you an idea, when we came into this year, the market forecast for US interest rates for the end of 2022 was that the interest rates would be at 85 basis points, so under 1%. 0.85. 0.85%. They are now at 4.85, and probably as we go into next year, we'll have definitely a 5 handle and maybe a mid 5 on them, right? The issue with Europe is slightly different, okay, because what's driving the inflation in Europe is very different to what's driving the inflation in the US. So in Europe, the inflation has been driven by energy costs, no surprise there, and also supply chain issues, okay? The problem with both of those as a form of inflation is the central bank only has one method of calming things down, and that's the interest rate. Now, the interest rate makes absolutely no difference to the availability of energy and therefore the price of energy, nor does it sort out any supply chain issues that we may know of, right? So the ECB are kind of in a bit of a bind because I use the analogy, they're a bit like a workman who has arrived up to a job with a toolbox full of screwdrivers, but he needs a spanner, okay? So the tool that the ECB have is no use for the job. In the US, it's very different.
Well, hang on a second now. To be fair to the ECB, they do have a thing called inflation to try to quell.
Yes, but their interest rates are not going to be able to do that. That's the problem. So the only way they're going to cure inflation in Europe is turning on the natural gas, turning on the oil, and getting supply chain issues sorted out. That's the only way. Now, the real risk in Europe is that inflation in those two areas starts spreading and becoming endemic within the economies, in that you will start to see wages cycling up, and other costs beginning to cycle up. That is the ECB's real worry. But
that is happening.
It is happening.
In a huge way.
Yeah, it is happening, and it has already happened in the US, right? But the problem that the ECB have is when a central bank is putting up interest rates, it's because the economy is doing really well and they want to kind of take the heat out of it, right? This time, the economy is not doing very well. It's inflation caused not by excessive economic growth, but by these two other factors. And the risk for the European Central Bank is that they try to slam the brakes on, and all they do is basically put the economy into a wall, right? And the other big problem for all central banks at the minute is, if you think back, right, we haven't had a proper interest rate increasing cycle since the start of the century, all right? So to a large extent, there's a whole load of investors, okay? And if you think about it, like the global financial crisis was 2008, okay? So that's 14 years ago. Now, if you look at the amount of investors and advisors and everything that work in investment markets right now, you need to be over 40 to remember pre-financial crisis, okay? There is an hell of an awful lot who are not over 40. So for an awful lot of them, they're pretty traumatized by this, right? And it's funny, every time I say it, I remember when interest rates were 6, and then there's some very old grisly people that I work with. 6? I remember when I was paying 18% on my mortgage.
You're talking to one. You're talking to
right?
one.
So the issue for the central banks is, it's a bit like getting into a car that you've never driven before to test drive it, and you take it out on the road, and you slam on the brakes. You don't know how quick it's going, because you've never driven the car before. You don't know how quick it's going to respond, how quick it's going to stop. And that's what we've seen with the central banks and their interest rates.
Ah, come on. There are books. I'm sure there are YouTube nowadays about telling you how to do it. Come here. I have to hold you for 1 second, because we do have to go for a quick break and help the economy to boom a little bit more.
De facto shaving oil, the world's best shaving oil. Made in Mayo, sold worldwide.
Want to increase sales, reduce overheads, and provide customers with a better service? Then use Big Red Web, the easiest way to develop and maintain your website. It gives you powerful business reporting, digital marketing, and automatically integrates with the award-winning Big Red cloud accounting software. It's a game changer for SME businesses. It's so good, the government gives you a €2,500 grant towards it. Big Red Web, e-commerce made simple. BigRedCloud.com/web.
Thinking of travel? If so, make sure to make De facto, the world's best shaving oil, your choice of travel companion. A 25ml bottle of De facto means no hassle at airports, no bulky cans to carry, and the guarantee of the world's best shave. DeFactoShave.com.
All that great business show advertisers are Team GBS approved. Back them.
And I'm back again with Aidan Donnelly, who is head of equities at Davy, who is still being evasive and won't tell me how to make some easy money in 2023.
Well, I have told you you're not going to make easy money, but you can make some money. How about that? Let's split the difference and talk about how you can make some money.
Please do.
Right. So we said earlier before the break that because volatility is going to be around, sometimes that will frighten people away from investing. I actually think, or push them into ultra-safe things like utilities and utility stocks and consumer staples, nice, safe companies. And things like that. I actually think that's potentially a very big mistake, because going back to that talk we had earlier on about valuations, the valuations are very expensive in those type of sectors. So what do you do in that type of environment? Well, the most important thing to do in that type of environment is you need to know what the right level of equity market exposure is for you. So you need to go and do a financial plan. You need to look and you go, right, there's 2 of us sitting here. There could be 20 of us sitting here, and there's 20 different answers, all right? It depends on your own personal circumstance and depends on what you're trying to get.
Do people not try to punt anymore, as in just to have a little side job?
You see, this is the whole thing. If you've done up a proper financial plan, you've got your bit that is your pension and your core stuff that you want to keep safe, and then you've maybe got other needs in terms of your investment. It might be your kids' education, it might be your holiday home, it might be whatever it is, and then you can still have a little pool of money at the other end.
Well, let's talk about that little pool of money, because that's the exciting bit. That's the bit that
but the rest of it can be very exciting too.
Okay, I know.
Right.
To somebody who's head of equities in Davy, maybe. To a fella who is listening to this, who just says, listen, should I put money into Nike? Should I put money into Boeing? Should I put money into something? What are you saying?
I'm saying you should. But
Which one?
I think what you should do is, right, what you mentioned there was 3 very good quality companies. I think that's the first thing that's important. You know, I always say to people, the investment tips you get at 11 p.m. on a Friday night in a bar are not good investment tips, all right? So if you haven't heard of the company, first thing, it should raise a red flag. So stick with good quality companies, right? And then the other thing you need to be cognizant of is getting a bit of diversification in. So don't go all on black or all on red, right? Depending on how much you've got to invest, get a spread of 15, 20, 25 names, something like that, so that you're spread across different markets.
Well, now I'm going to hold you there because now just... Again, for a general audience, they will not have maybe know of what an ETF is, and this is a very easy way of spreading your risk.
Yeah.
What is an ETF?
So we everybody will have heard of the major stock market indices, be it the Dow Jones, be it the Isaac, be it the FTSE 100, be it the Euro stocks. So there are securities out there that basically replicate exactly what's in that index. So you might say to yourself, when we take the S&P as a good example, there's 500 stocks in the S&P. The Standard & Poor's 500, okay? It is the benchmark for US equities, okay? A lot of people look at the Dow Jones, but it's a completely irrelevant index. That's the first thing you learn when you start in this business. The Dow Jones is not worth toss. It is the S&P 500 that you need to be looking at, all right? So an exchange-traded fund, if you wanted to say, I want to get exposure to the Standard & Poor's 500, you'd have to buy 500 stocks. And unless you had a very big portfolio, you just wouldn't be able to do it. But an exchange-traded fund is one security that basically mimics completely what the return on that index is going to be. So if you say to me, listen, I don't know about individual companies and I don't have time to look at them, but I do think the equity markets are going to go up. An exchange-traded fund is a really clever and efficient security to invest in, because that's what you just want. Now, as I said, you can get it for the S&P 500, you can get it for the FTSE 100. If you don't even try to make a decision between certain regions, you can buy what's called the MSCI World ETF, which is just basically global markets, and you just go, well, that's what I want. That's why I think they're going to go higher. Now, they are a very efficient way of doing investing because you get great diversification, because if there's 500 companies in practice under your one company if you have the S&P exchange traded fund, but you're also buying stuff that you might not want to own, right? And that's the rub in an exchange traded fund. So people can either say, well, I don't care about owning stuff that I don't necessarily want to own. I'm just interested in getting good exposure to the equity market, therefore I want to buy these. And I think they are very good. And what is really, really clever about them is, if you get worried about the market, you can literally just take down your exposure very, very quickly because you're only selling one security. Whereas if you had a portfolio of 40 or 50 stocks in it, you have to go down and go, do I like that? But I really like this one. And then I don't, and you have to kind of go. And then ultimately, emotion gets involved because the individual names and you want to go, no, I can't really sell that. No, that's a great one. And you end up not doing anything at all. Whereas if you have an exchange-traded fund, you're able to do that just in and out.
Now, you said some people do nothing at all. Sometimes that is a strategy, and sometimes it's a very successful strategy, just to stick with it over the years.
That is, I run several direct equity portfolios for Davy, and I have a very low, what's called turnover rate, which is basically the amount of changes that you make to that portfolio. And the main reason I have that low turnover rate is because I don't think trading adds a lot of value. Everybody thinks A, trading is easy, and B, it adds value. All right, it is not easy.
When you started in this business, did you think that it was easy and that it did add value?
Yeah. And it's funny.
So this is the benefit of your wisdom.
Yeah, because I'll give you a good example. So I have 2 investment pots. I have my pension, and I have what's called my trading account. When I started off, I would have been in my trading account much more than my pension. Now, I just buy stuff from a pension and I leave it there. I buy really good quality companies that I know are going to grow strongly over time. And it's not necessarily the household names, but they're names because I'm in the business that I meet, because I meet an awful lot of companies, and you'll see a company and you know what you've been in, and you'll meet the company and go, that's actually a really, really good stock. And people might not know it too well, and you just kind of go.
I always remember the one that you told me a long time ago, the fellas who make the tools, for the car.
Snap-on.
That's it.
Snap-on. They have had an unbelievably strong year this year. They've been one of the best performing industrial companies in the US.
Explain what they do.
So basically, people will have seen them. If you ever happen to be driving by a mechanic's garage or a car dealership, you might see a Snap-on truck outside.
Particularly in the States, isn't it?
Particularly in the States. But there is a few here, and it's funny, there are definitely a few here, because I have seen them out and about. And what they do is they sell tools to mechanics and to car dealerships and things like that. And I always remember, the big worry many years ago was that as more and more electric vehicles came on, everybody said, there's going to be no need for spanners and things like that because there's no engine. And I always remember the CEO turning to in a meeting, and somebody said, they said to them, electric vehicles, there's no engine in there. What would you need spanners for? And the CEO just turned to me and says, I don't know much about the mechanics of a car, but he said, I do know electric vehicles generate a couple of thousand volts of electricity. I don't fancy sticking a metal object into the middle of that and hoping that everything's going to turn out all right. So he said, we might not have spanners, but we're going to have a whole new set of instruments and tools that are going to be needed for things. So that is definitely good, and it's been a very, very good company in terms of its performance. And that's what a lot of people should be thinking. As I say, people want to make quick buck. Turn it in quick. But it's very, very hard to do. You make far more money by just buying good quality companies that you know can grow and that you're not paying mad valuations for, and just park them aside and don't look at them, right? And don't look at them, and come back in a few years' time and they'll have performed handsomely for you through the economic cycles.
And all the listeners have now worked out that I've finally ground you down. I've broken his spirit, and he's actually talking about specific investments. But, Aidan Donnelly, we're going to take a quick break, and we will get back to more specific investment ideas.
De facto shaving oil, made only from natural oils. Nothing nasty on your skin.
Want to increase sales, reduce overheads, and provide customers with a better service? Then use Big Red Web, the easiest way to develop and maintain your website. It gives you powerful business reporting, digital marketing, and automatically integrates with the award-winning Big Red cloud accounting software. It's a game changer for SME businesses. It's so good, the government gives you a €2,500 grant towards it. Big Red Web, e-commerce made simple. BigRedCloud.com/web.
Viscosity. When you shave, you want the highest viscosity because it helps the blade run smoother. De facto, the world's best shaving oil, has incredible viscosity. That's why De facto leaves your face, underarms, or legs nick-free. Higher viscosity makes blades last longer. De facto is the best for your skin and your pocket. DeFactoShave.com.
All that great business show advertisers are Team GBS approved. Back them.
And I am here still with Aidan Donnelly, head of equities at Davy. I think he's on the floor crying at this stage. He's been beaten up so badly. Aidan, Snap-on, give me some more really lovely little companies that you think could make a few quid for somebody. Of course, I should put in the caveat. Take professional advice.
Absolutely, and again, this is not about as I said, picking one or two names. It's about spreading it across spreading it across a diversified portfolio of names. I think it's funny. One of the most interesting themes I think that are going to play out over the next few years is the whole area of capital expenditure, or capex, industrial capex, right? And the reason I think it's very interesting is if you look at the developed economies, so call it Europe, call it the US and things like that, there's been a chronic underinvestment in capex over the last 3 decades, right?
Well, hang on a second. Capex to Kerry Group is different to capex on, IT needs for a company.
Yes, but if you think about physical capital, right? So machinery and all of that type of thing, and even in technology companies in terms of moving to the cloud and all of that type of thing, there's been a chronic underinvestment, particularly in manufacturing in the Western economies. All right, now that made perfect sense in that if you were going to move and single source all of your components and products and everything from a supplier in China or your own manufacturing in China, okay? Why would you need a state-of-the-art manufacturing facility in Milwaukee or in Leixlip or wherever, right? You wouldn't, right? But I think there's 4 major trends now happening that mean I think companies are going to have to start increasing the amount of money they spend and invest in their facilities closer to home, or their suppliers will need to invest in facilities closer to home. The first and most important one, I think, is reshoring of supply chains. So we'll all remember in COVID when everybody was getting everything they ever needed out of China. It was great until China completely closed down and you weren't able to get anything, right? So what is happening now is we're seeing a lot of companies say, okay, I still want to produce most of my stuff in China, but I need to find somewhere else a bit closer to home. And that's what reshoring or nearshoring is all about. All right. Now, it might only be that it's 20% of what you're producing or what you need, but you're finding somewhere. Now, if you're doing that, those new facilities have to be of the same technical standard and efficiency and everything as whatever you were getting it from in China, because otherwise it doesn't make sense. So that is creating this big demand for capital equipment and all sorts of stuff to be manufactured and put in place nearer to home, if you will. Now, again, as I said, it doesn't have to be on your doorstep, but it is probably nearer than Asia. So reshoring or nearshoring is one thing. The second big driver is automation, right? Now, typically when we mention the word automation, everybody thinks, oh, it's going to be big job cuts. We're going to replace humans, and that's what's going to happen. Boom, boom, boom. Actually, it's very different this time. And the reason it's very different is because of the chronic labour shortages, particularly in manufacturing. So the reason you're putting automation in now is not to replace workers, it's to fill gaps that you can't find any workers for, right? I had a very interesting conversation with a couple of the younger members of staff a couple of months ago, and I was talking about this, and I said to them, they're all in a category of, 24 to 32 or something like that, and I said, how many of you have friends or know people that work in manufacturing? And there was 8 people in the room and none of them knew anybody, right? Because it's just not done anymore by that age group. And what's happening is, and we've seen it post-COVID in terms of, there's this talk of the great resignation, right? And that's mostly people in 50 and above going, to hell with this, I'm too old, or I just want to change a job, or I want to slow down, my body can't cope with this anymore, I need to have everything, and they just haven't gone back to work. Like, we've seen a massive fall in what's called the participation rate in the US, all right, in that about over the 2 years of COVID, about 1.3 million people entered retirement and went into retirement. And the US is a bit strange in that an awful lot, you still get a large cohort of people who, even though they're at retirement age, continue to work, right? That's about another 600,000. And they have decided, I'm not working on it anymore. So you're getting all of this workforce is coming out and it's not being replaced. So automation is not just about filling the gaps, but it's also about, if you want to improve efficiencies and optimize and lower scrappage and lower costs and things like that, the application of technology into manufacturing is huge, all right? But it's not only about manufacturing, all right? It's about services as well. So if you think about it, the best example I can give you is, let's say 10 years ago, you went into McDonald's. What did you see?
fellas behind the counter and all that.
Eight or nine people behind the counter ready to take your order. Go in today. What do you not see?
There's nobody there, but you also have to go to that blooming thing.
Well, you see, you're just a technophobe, right? But a Luddite.
And then where do you stand? You're kind of looking at the ceiling and
look on your phone. Another bit of technology, right? But the difference is there's now only two people there, and it's even more so in the kitchen. Where they've managed to take the necessity of one or two people in the kitchen out by the application of technology. But what's more important, and the other part of this automation is about optimizing your workforce, right? Let's say Conal is a really, really good employee, right? And 60% of his time is spent doing really good value-add stuff for the company. And the other 40% is spent doing mind-numbing crap that really a computer or a robot or something should be doing, right? What I want as a business owner is for him to jettison the 40% and be spending 100% of his time on the stuff that is adding value, right? And that's where the move to digitalization, move to automation is about making sure that the people that have a skill set are using that skill set.
Not for the first time. You are going to run out of time because you have to give me two further themes, and you're not leaving the studio without giving me some recommendations.
I'm building up.
Yeah, but you're going to run out of time.
Right. Okay, two other themes. The last one, we've done reshoring and nearshoring. We've done automation. The next one is obviously a very easy thing, Internet of Things, or the Industrial Internet of Things, and that basically means connected machinery. Why is that important? Because it allows you to schedule preventative maintenance in your manufacturing. Because manufacturing production lines are so integrated right now, if one machine goes down, your whole line goes down. Could be down for 2 or 3 days, right, until the thing. So all of the new machinery now is now connected. It runs self-diagnostics every minute of every day, reports up to the head of manufacturing. I'm feeling pretty good today. Then one day it goes, belt number 7 on cog 8 is a little bit wobbly, lads. You might want to get somebody to take a look at that in the next few days. Then you're able to schedule that maintenance for whenever, because you know what the problem is. You have all of the parts and everything there, and whoever's going down to fix it knows exactly what they're looking for, and they go down and fix it. And instead of your production line being gone for 2 days, it's gone for 2 hours when you want it to be down for the 2 hours, all right? So that's really important. And then the last thing is really just about the electrification of the grid, okay? And we talk about electric vehicles and things like that, but just think of everything else that is out there. So all of this means you are going to have to spend lots of money on capex. Now, we're already seeing that. If you looked at the second quarter results season in the US, capex was up 18% year on year,
which is massive.
Massive, right? And it's going to be the same in the numbers. I have yet to see the numbers for the third quarter, but it'll be about the same. Companies have the cash, right? Their balance sheets are in very good stead. They have the cash and they want to spend it. And what's interesting, I was in the States in November and I met about 30 industrial companies, and they were all saying to a man, everybody's talking about a recession next year, and they go, look, we're prepared for the recession that you say is coming, but we're not seeing it in our business because we have to spend on all of this stuff. We can't take the risk of saying, we're very worried about a recession that might last 6 months next year, and waiting and then going to their supplier in 9 months' time going, listen, great news, lads, the recession is over. We'd like to have our capex plan rolled out. And their supplier goes, that's lovely, but I have a 2-year backlog and you can join it then if you like. And they're now 3 or 4 years behind their competitors. And what are they going to do? There's not a lot they can do. So they are continuing to invest, and I think they will continue to invest, all right? So in terms of those types of companies, you've got a whole gamut, and it's not about the important thing here is it's about multiple different types of sectors. So it's not just about technology; it's the application of technology. So there are technology companies, but there's also industrial companies that will do very, very well, and there's also service providers that will use all of that and use technology to do very, very well. All right. So it is things like the big technology giants, be it your Siemens or your Schneider in Europe, your ABB in Europe. In the US, it's things like Parker Hannifin, Rockwell Automation. On the technology side of it, it's things like, it might be a Cognex or an Autodesk or a Keysight Technologies. All of these companies that facilitate this large drive to thing. I don't think those trends go away. And if you are interested in, what is going to be the long-term investment winners, it's latching onto those types of themes that have multiple years to play, and you just buy the stuff, you park it away, and you don't get worried.
Now, you rattled out a whole heap of names there. Do you have favourites? Like Brown Lad is one horse that's going to run on the 330. Do you put money on Brown Lad? Or if you were going to take all of those capex type companies, can you buy an ETF just on capex?
You can. There are automation and robotic and automation ETFs out there.
I love this stuff that you can buy nowadays. It used to be.
Yeah. Now the problem again is come back to the same problem of the ETF with the S&P 500. You can with all of those, you're buying stuff that you might not want. All right.
But if it's a theme and that you believe in,
why not put together a list of 10 names and just buy those 10 names?
So which ones would Aidan Donnelly?
I'd have them. All of those that we listed.
Siemens, ABB. I was trying to
Schneider Electric.
Okay.
Yeah. Rockwell, Cognex, Parker Hannifin, Keysight Technologies. There's so many of them. There's so many. That's the one thing about this.
You have to choose the right
No,
ones.
you don't. And that's the thing. That's what people think you have. People fundamentally forget. When they look at my job, they say, you must get everything right. I don't get everything right. I only have to get 55% of the decisions right in a short period of time to be making some money. If you have long enough time horizon, you can get even less right and still make decent money because you're on fundamentally good growth stories that are out there.
You send out a lovely email every Monday. Can anybody get that?
Clients can, yeah.
So if they go to you, it's worth a read. Yeah,
I try to be a little bit off beam sometimes, know.
No, but you also put in at least one stock.
Yeah,
and it's either buy or sell.
Yeah, it's my Monday Insight. Yeah, Monday Insight.
So if anybody wants to do that, they can get on to
Davy and get an advisor, and they can be signed up for that. Absolutely.
You're going to be so popular in there.
Oh, listen.
Come here to me. Final question we ask everybody. And I think you probably answered this before, did you?
Yeah, and I'm going to give you a different one this time around.
Oh, good man. Who would Aidan Donnelly hire in a heartbeat?
There's lots of CEOs that I've met. I think the last time I mentioned a guy called Andy Silvernail, who was the CEO of, at that time, he was the CEO of a US industrial company called IDEX, right? Now, he's subsequently moved on from that post. But I'll give you another one that I think is a really, really great CEO. It's a fellow called Hal Lawton. Okay, and Hal is the CEO of a company called the Tractor Supply Company, right? And the interesting thing about this company is the one thing they do not do is supply tractors. Okay,
that's a good start. Always name your company after what you don't do.
So this is a retailer, and it's a US retailer in the space of what's called the hobbyist farmer. Okay, so it's kind of suburban people who have have freeholds in the US, and they have animals. They might have horses, dogs, cats, all of that type of thing. But it's a bit like, I think the best example you could get closer to home. Do you remember years ago there used to be the co-op stores down the country?
They still are.
They still are. Okay, well there you go.
Jeez, you're some dope.
I know. But so it's that type of thing, but it's a really, really slick operation. And Hal has come in. He came in about 3 or 4 years ago. He was Home Depot before that, and he was eBay before that. But he's really transformed the company with the use of, again, digital technology, developing an app for customers, and also then just rethinking about the retail space. Fabulous CEO.
Okay, well, Aidan Donnelly, Head of Equities at Davy, thank you so much. But we will put in that caveat again. Take professional advice. There's a reason why people like Aidan look at screens all day. I don't know what it is. They might be watching football or something, is it?
Well, it's to make sure that clients don't have to do that, because that's what's required to do in order to have success at investing.
Well, a very, very prosperous new year to you, Aidan Donnelly, from That Great Business Show. And that is it from That Great Business Show, episode 120. And since you have just listened to it, you know that the last 45 minutes is equal to a full year's teaching at the Smurfit Business School. So please repost on LinkedIn and send the link on WhatsApp to your besties in business or anybody who wants to have a punt in the markets. They'll love you for it. And turning to our own business, if you would like to advertise with us, give me, Conal O'Moran, a shout on LinkedIn or on Twitter, where I am at Conal OM. Should have asked you if you think Twitter's going to last. Probably won't, will it? No, that's what I think I know. We record at the Dublin South Podcast Studios, where Lee Push the Button Brennan is today's sound engineer. Later, Neil Horner mixes it all up in post-production. The same team also works on our second podcast series, that is Ireland's legal podcast, The Fifth Court. We can make your podcast dreams come true. We bring podcasting to another level. All of our great business insights and tips are brought to you, as always, thanks to our sponsor, De Facto Shaving Oil, the world's best all-natural shaving oil. They back us, do back them. DeFactoShave.com is what to look for online. And do not forget to buy Business Plus magazine, where we now have a regular column all about the podcast. And so from me, Conal O'Moran, Míle buchas for listening, agus slán tamil, and a very, very happy new year. Avlian Frivache.